on ET Now. Brought to you by the new Renault Pulse. Add Pulse to life. HCL, technology that touches lives.
Hi there and welcome to yet another episode of Market Makers, a show wherein we interview all the bigwigs of the market and get their views on the current happenings and the near-term outlook and the medium-term outlook for the market. A very special guest with me today, a man needs no introduction, Ridham Desai of Stanley joins us right now on the show. Ridham, great to have you. Thanks so much for joining in. Let's just start off with what we've left behind in the last 30 days, and that's a very news-heavy month, so to say, with the UP elections out of the way. 2-3 events which were key, which have been left behind, and now the market looks forward to earnings and possibly even the RBI policy. How do you map the course of the markets over the next, say, 1 quarter?
I think we should not disregard the events of the last month. A couple of very important things happened. I think the UP state elections was an important continuation of a trend that has been developing in India for the past 5 years. The electorate in India has certainly turned for a change, and it has been successively delivering strong mandates to either performing incumbent governments or new governments if the incumbent was not performing. And this is with the view that it is focused on development. And to me, if you turn around UP, it could have a big impact on India's growth rate, because I would argue that UP has been a drag on India's growth rate, just the way Bihar used to be. And we've seen the turnaround in Bihar over the past 5 years, and I think a turnaround in UP is fairly possible. It being the largest state in India and being a drag on India's growth rate, I think the potential is enormous. So to me, I don't think it was an event that we should just ignore. I think it was an important medium-term development for equities. Then the budget came, which obviously I think was probably less than what the market expected in terms of the noise it created. But I think the finance minister made a fair attempt at fiscal consolidation. Today, I think the market is skeptical. It's reflected in bond yields, it's reflected in equity valuations. So from an equity investor standpoint, it's a good thing, because you don't want to buy a market that is optimistic. You want to buy a market that is pessimistic. And if the market is wrong, then you make outsized returns. So I think we are in that situation. So to me, I think the March events were quite crucial. Coming to April and May, yeah, I think I agree with you. Corporate fundamentals, clearly something to watch out for. I'm focused on margins. I think we've gone through 5 or 6 quarters of falling margins. Corporate India has just not had the pricing power in an environment where costs have been rising relentlessly. So margins have got crushed. Top line growth, mind you, has been very strong, and it defies the prognosis that Indian economy has not been doing well, because if I look at a sample of 3,500 companies that we track, they've grown their top line by between 20 and 25% for each of the last 4 quarters. Okay, and that doesn't really signify a 6% economy. So there's something amiss there, and I'm not able to square the circle, but it seems like the underlying fundamentals of the economy are not that bad as the headline numbers suggest. However, corporate profits have taken a big hit because margins have fallen. So to me, I think in the next 2 or 3 quarters, revenue growth slows down, probably into the teens, and I expect margins to start improving, because I think inflation pressures are subsiding, and that itself will cause margins to rise, and therefore corporate profits will improve. And this quarter may prove to be a critical turning point in that regard. And yes, the RBI. I think the fiscal deficit number, I think, should have given the RBI comfort, notwithstanding the market's skepticism. So I think it does create room for them to make their first move on rates. So I wouldn't be surprised if they make their first rate cut. And maybe a CRR cut may also happen. So I wouldn't rule that out either, in order to manage the liquidity situation better.
What happens to fund flows to India if indeed oil stays at these levels? Because there are positive positive arguments for oil coming down because of how global demand isn't that strong. And of course the geopolitical tensions working exactly the other way. So oil stays at these levels, the elevated levels, and the currency being at the levels that it is by virtue of India being such a large net importer. Does it spoil the macro picture or damage the macro picture so much as to affect fund flows, or you don't think that's a concern?
No, indeed, that's the case right now. I would argue that the macro picture is already fairly damaged.
That hasn't shown in fund flows, so which is what I was asking.
Yeah, but because that's in the price, right? You know, we are talking about fund flows into equity markets, right?
Sure.
So they will respond to what's in the price. So the market is already pricing in a fairly poor macro picture. The market is pricing in 9% bond yields. The market is pricing in significant deceleration in earnings growth. Actually, we did some calculations. The market on a 1-year forward basis is telling us that earnings will fall by 7%. So it's quite pessimistic about the outlook. So it's in the price, right? So if it's in the price, then I want to take the risk that the market may be wrong about what's going to happen, and there is upside risk. So, you know, the way I actually, when we talk to our clients, we're talking about the upside risk more than the downside risk, because I think a lot of the downside risk has played out in the last few months. Now, that doesn't mean that India's macro has turned around, that we have suddenly fixed everything. We haven't. But the risk is that if something of this gets fixed, then equity prices will give you outsized returns, because equities are right now pricing in a fairly dire outcome.
You are bullish on the markets from the current levels, assuming that the negatives don't turn out to be worse. I mean, bond yields don't go up majorly above the 8.75, 8.8 mark, and crude and currency doing what they are doing right now. Are you more bullish than bearish?
I would say that at the current levels of Nifty, which is around 5,200, with a 12 to 18 month view, I think equities probably will be the best performing asset class in this country. Now, if you look at 2011, it was the worst performing asset class. It actually delivered negative returns, as we know. But in fact, even over the last 5 years, equities have been a very poor performing asset class. And over the last 5 years, it has underperformed inflation. So you've not even been paid the deterioration in the value of the rupee because of inflation by equities. So equities has been a terrible asset class. I mean, contrast that to gold or even fixed deposits. Actually, you know, they have been far better asset classes. Now, this is abnormal.
Sure.
And it will normalize over the course of the next several months. And I think at this starting point, it definitely makes equities probably the most attractive asset class in India.
Why not go with the best? Yes Bank now offers 7% per annum interest rate on savings accounts. Say yes to growth with Yes Bank.
अब हम मुंबई की उड़ान
भाई साहब, ये हम कौन से प्लेटफॉर्म पे उतरेंगे? जहाज में बड़े बम पटाखे घूम रहे हैं।
Where has this joker bought his ticket from?
अरे वो
Don't know about him, but मैंने खरीदा है goibibo.com से. Presenting goibibo.com, India's fastest online travel site. Log on and book your travel now.
हमारे 2 कल होते हैं, एक बीता हुआ और एक आने वाला। बीते हुए कल में जो भी मांगा मिला। उम्र बढ़ी तो इच्छाएं भी, और आने वाले कल में भी कई इच्छाएं होंगी, लेकिन शायद इनकम नहीं। एक चीज मैंने सीखी है, इच्छाएं ना उम्र देखती हैं ना इनकम।
इसलिए रिटायर रिच बजाज अलियांज कैश रिच इंश्योरेंस प्लान के साथ। Bajaj Allianz, जियो बेफिकर.
Presenting India's biggest awards recognizing the performance of stock analysts and brokerage houses.
I believe you're going to see a resurgence of activity in the Indian market.
Which of the analysts and brokerages will win top honors at the awards?
I think that investors should still have a very underlying positive view of the world outlook, reflecting the strength of the emerging economy.
PC Jeweler presents ET Now Star Mine Analyst Awards 2011-12. Only on ET Now.
Star Mine Awards presented by PC Jeweler, jeweler for generations. In association with Panasonic Econavi AC. It's one touch to change the future. Standard Chartered Bank, here for good.
No PR, only hard news.
News that moves the market.
Everything that matters to the new economic thinking.
The only show that puts corporates and policymakers on the spot.
Tough questions looking for straight answers.
Now everybody's tired. Thousands of people on the ground. Big faces with big stories as they break. Business Tonight at 9, weeknights.
Only on ET Now.
Brought to you by Vedanta, creating happiness. Flipkart.com, the online mega store. Aditya Birla Group, taking India to the world.
In these
Choppy markets let our experts help you maximize your portfolio. Our experts this week are A.K. Prabhakar, Rohit Shinde and Lancelot Tikona. Catch the thrilling game of portfolio building on BNSN The Stock Game, only on ET Now.
Brought to you by HCL, technology that touches lives.
What in equities, Ridham? I mean, there are two cycles operating right now. One is consumption, which is trading at premium valuations compared to the rest of the market and still finding favor. And there is the butchered out lot, which continues to languish. Though, of course, there has been a bit of a bounce back from those abnormal lows, but still not finding too many takers. Where are you finding favor on this bullish stance of yours for the next 12 months?
See, I'll break up the macro cycle into 4 parts. Okay. So we have discretionary consumption, which I think is in good shape, and I don't see any reason why that's actually going to suffer. In fact, if rates come off, as I expect they will, it will actually help discretionary consumption. There are a lot of structural trends in discretionary consumption. So there are shifts happening, category shifts, as I call them, and a lot of stocks and sectors will benefit from those category shifts. So consumption in this country has always been high, right? But it is primarily in very basic stuff like food, shelter and clothing. As the country becomes more opulent, as income levels rise and as wealth rises, we'll see category shifts. We'll move out of food, clothing, shelter into other categories. So we see discretionary consumption, discretionary services gaining more share. So I'm bullish on things like entertainment, media, autos, most of these areas of discretionary consumption, especially in urban India. I think rural India is going through a soft patch cyclically because I think the government has pulled back on spending and rural India has suffered negative terms of trade, which is that food prices are now rising more slowly than before, and therefore they're suffering from a negative terms of trade, which I think is the opposite for urban India. So one theme is urban consumption. So you need to be positioned in urban consumption. Then the second part of consumption is staples, the so-called staples. Now a lot of those stocks are actually quite rich in terms of valuations. So no doubt their fundamentals are very good, but the valuations are not appealing enough. And in the end, when you're investing, you have to pay cognizance to both fundamentals as well as valuations. So where the staple stocks don't make the cut is that they are already pricing in the good story. So I avoid that basket. On the other side is your investment story. Now again, investments are 2 parts. One is the manufacturing capex and the other is the infrastructure capex. I would argue that there is still some time for manufacturing capex to recover. And let me pause and explain that. The reason I'm saying is that between 03 and 08, corporate balance sheets in India expanded enormously. We had a 30% CAGR in asset growth. A lot of capacity got created. Then we got the financial shock of 2008, and since then growth has been relatively tepid. So utilization rates which fell in 08 have still not recovered to levels where a capex cycle gets triggered. We actually do this in terms of asset turn. So the asset turn, which is the rate at which you turn over your assets, is still 30% below the average of the last 10 years. Now, unless that normalizes, we will not get a big manufacturing capex cycle. So in my view, that's a sector you want to avoid. So that's generally your capital good companies. Having said that, I still think that infrastructure will behave a little differently because arguably there is a shortage of infrastructure in the country, and infrastructure has been, I think, hurt because of policy lacunae. A lot of those things should start getting fixed in the next 12 months. So I think a recovery in infrastructure capex will happen. So within capex, I think there are 2 parts. So I wouldn't mind actually buying a bit of infrastructure capex and discretionary consumption. And then one sector which doesn't fall in the discussion of India's macro is technology, which falls in the discussion of global macro. I think the global macro is wonderfully set up for Indian tech companies. It is not very dissimilar, though I would not draw that parallel, so don't misunderstand me, but it's not dissimilar to 1999. Tech spending, I think, is set to rise considerably in the next 2-3 years.
Because it hasn't happened till now.
In the last 4 years, there's been very little tech spending. Also, we're getting some new trends in technology, like cloud computing, like social networking. The need to outsource, I think, is a lot more than it has been for the last 4-5 years, because corporate America, corporate Europe need to protect profitability in an environment where growth is likely to remain sluggish. So they need to cut costs. So I think Indian companies have a very good environment. And if you look at the stocks, they're not pricing this in. They're relatively cheap compared to where they have been in the last 5-7 years. So that's the sector you want to buy. So I think that's how a portfolio can be constructed. A bit of infrastructure, real estate, a lot of discretionary consumption, and a fair bit of technology.
Would you, I mean, I know you can't speak stocks, but would you segregate amongst the IT companies, or do you believe that the basket as a whole, because of business models being, I mean, broadly being similar, all of them would broadly benefit, and there will be a couple of them which will do business much better and therefore benefit more?